Today, did hopes of a rate cut stoke the property market? Hello again, it's Martin North from Digital Finance Analytics Web Notice Post covering finance and property news. Well, the news outlets are full of more property news, with some spruiking that the hope of a rate cut in February has spurred people into action after the holidays, with a focus, by the way, on Melbourne property prices rebounding. Rich Harvey, chief executive of buyers agency Property Buyer, said Melbourne could surprise on the upside in the next 2 years. I think Melbourne is the best counter-cyclical buy, he said. It's the most undervalued capital city. You can buy apartments almost below replacement costs, for example, in southern Melbourne, which is incredible. So I think Melbourne will be very strong next year, and even more so in the following year. In the meantime, Shane Oliver over at AMP tweeted, "Clearance is up sharply, possibly helped by rate cut talk, but they're only back to average levels for February and have come on low volumes. Expect February rate cut talk to provide support." So let's look at the data and see what is happening. Actually, the January update on prices from PropTrack showed that nationally prices fell just 0.1% in January to a median value of $796,000. Looking in more detail, Melbourne fell by 0.3%, Hobart fell by 0.5%, Sydney fell by 0.2%, Adelaide fell by 0.1% along with the ACT, while Perth was flat. Regional areas did a little better, with the rest of WA up 0.9%, the rest of South Australia up 0.6%, regional New South Wales up 0.2%, although regional Victoria did fall down 0.2%. And nationally, unit prices were down 0.3% in the month, while houses were flat. The PropTrack model measures monthly changes using a hybrid methodology that combines repeat sales and hedonic regression methodologies to control for the effect of observable property characteristics on prices in residential dwellings across Australia. They say that this hybrid methodology has the benefit of augmenting the repeat sales methodology so that dwelling price growth can be more robustly estimated in regions where there may not be sufficient volumes of repeat sales transactions. One notable fact is that the entire history of the indices are recalculated each month. The revisionary nature of the index guarantees that as soon as sale transactions are observed, they are incorporated into the index to provide the most complete and accurate assessment of the change in values over time. Now, this is an important and distinguishing feature of the PropTrack HPI because it compensates for the delay in receiving the official records of sales transactions after they settle from state and territory valuer general offices. So this is why we sometimes get a different read from this HPI compared with others out there. As with any model, though, it is only an average estimate and does not go granular enough to be really helpful, but I guess it makes good copy for the journos. Clearance rates are another metric in focus, but as I've discussed before, they're also full of holes. Specifically, preliminary clearance rates generally fall as a result of more auctions are collected. Domain reported a 66.6 national clearance rate, but a year ago it was at 60.6%. CoreLogic's preliminary data showed that the combined capitals returned a clearance rate of 65%, and while, according to CoreLogic, the preliminary clearance rate in New South Wales leapt to 67.5% from 59.5% a week earlier, the preliminary clearance rate dipped from a year earlier when it was 70.6%. A rise in the number of homes coming onto the market and an affordability problem unlikely to be dented by modest interest rates are set to temper demand. In Melbourne, where the preliminary clearance rate was 65.4%, it was down from 67.1% in the same week a year earlier. Aspiring buyers, who now expect no further interest rate increases, have also hit the market earlier than usual in Melbourne's inner city northern suburbs, but it wasn't clear if that pace would be sustained, according to Karen Price, buyer's agent. There's a bit of, if prices go up, we're going to miss the boat Aspiring buyers who now expected no further interest rate increases had also hit the market earlier than usual in Melbourne's inner northern suburbs, but it wasn't clear if that pace would be sustained. There seems to be a bit of urgency. It'll be interesting as more listings hit the market. It might slow down. Brisbane's preliminary clearance rate of 58.7% undershot the 67.2% from a year earlier, when inflation had not started to come down and there was no realistic hope of a rate cut anytime soon. Adelaide's preliminary clearance rate of 61.7% also came down from the previous week of 68.1% and was well down on the 74.1% from a year earlier. Actually, only Canberra was up year on year, with a preliminary clearance rate for this week to Saturday of 68.7%, up from 58.6% a year earlier, according to CoreLogic. So really, there isn't that much of a swing from last week, and listings are still rising quite fast. And remember, a small cut of 25 basis points or even 50 basis points this year won't pull mortgages back down very much, remembering that many had been enticed with loans at 2% or below before the RBA started its hiking cycle. And as for what's ahead, well, of course, no one really knows, which is why I run scenarios, which, by the way, I'll be updating shortly. But this week, we had predictions from KPMG. As discussed in the AFR, KPMG chief economist Brendan Rynne said Melbourne's house prices are tipped to climb 3.5% this year, rebounding for the first time since last February and slightly outpacing Sydney, fueled by improved housing affordability after 5 years of sluggish growth, while Sydney's housing values are expected to increase by 3.3%, which is also higher than the 2.5% gain last year. Although parts of Melbourne's housing market remains weak, the cumulative effect of the expected rate cuts would spark stronger growth this year. Melbourne's apartment values are set to rise by 7.1% next year. And he also expects Sydney's status as a major job hub, along with housing supply shortages, to offset the current challenges to poor affordability. By December next year, Sydney is predicted to reclaim its top position, with house prices expected to jump 7.8%, more than double this year's increase, followed by Melbourne's 6% gain. Sydney will revert to leading the country's housing market, and while Melbourne is currently experiencing a minor downturn in house prices, we expect prices to recover in 2025, KPMG said. While recent changes in the Victorian land tax and the current downward momentum may hinder growth, those negative factors are expected to be offset by positive demand. Melbourne's house prices are relatively more affordable compared to other capital cities, which will likely attract both interstate and overseas buyers. Eliza Owen, CoreLogic's head of research, said the 6.4% drop in Melbourne's housing values from its 2022 peak had boosted the city's affordability advantage. It makes sense to me that the market could pick up in 2025, she said. Net interstate migration made a strong recovery from big leakages in population during the earlier part of the pandemic and has returned to balance. I think the affordability advantage is a big factor. Even though some investors are leaving the state, there are also more first home buyers entering. Kate Bakos of Melbourne-based buyer risk agency Kate Bakos Property agrees that priced-out home buyers are returning. We're definitely seeing green shoots. First home buyers are very active at the moment, but many interstate investors are also coming in because of the value they see in Melbourne's housing market, she said. The share of first home buyers in Victoria blew out to 32% as of September last year, which was the highest among the states and territories. That's according to the ABS data. Overall, house price growth is expected to be modest this year, though, rising 3.3%, down from 5.2% a year ago, dragged down by delayed rate cuts and affordability constraints, KPMG said. House price growth is forecast to slow substantially in Perth to just 4%. And Brisbane and Adelaide are predicted to rise by just 3.1% and 2% respectively. And Canberra is forecast to recover this year, rising 3.5%, which is on par with Melbourne, while Hobart and Darwin are set to increase by 1.8% and 1.2% respectively. Next year, house prices in Perth, Brisbane and Adelaide are expected to rise at marginally higher rates of 4.6%, 5.6% and 3.6% respectively. Last year, they surged 17.5%, 11% and 13.8% respectively. KPMG also predicts that units will slightly outperform houses over the next 2 years, rising 4.6% this year and 5.5% the next year. Sydney and Perth unit markets are set to dominate this year, climbing 5% each, followed by Melbourne at 4.7% and Adelaide at 4.6%. By the end of 2026, Melbourne's apartment market will outperform the country, with its values gaining 7.1%, followed by Sydney's 6.1% rise. Nerida Conisbee, chief economist at Ray White, said the expected rate cuts would have a bigger impact on the Sydney and Melbourne markets compared with the other capital cities. At the moment, Sydney and Melbourne are both weak, but if we get 3 to 4 rate cuts coming through this year, that will provide a substantial boost to both markets, she said. So a couple of points here. Firstly, of course, the rate cut cycle may or may not start in February, and nobody knows how low it will go. Probably not as much as many are predicting. Secondly, I think all of this talk is overdone at the moment, because if you look carefully at the data, the momentum is still relatively weak, and we are seeing more properties being listed. I think that trend will also continue. And the final point is that within individual markets, some properties are going up, some are going down. So these averages and this overall high-level talk is relatively meaningless because it's actually down to what is happening on the ground. And in fact, Edwin and I will be chatting about this tomorrow because going granular at the moment is probably the most important thing of all. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Rynne Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Rynne an email at info@ryburnproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.